And we are watching shares of Dollarama today after the Quebec-based dollar store chain posted revenue growth from established locations that missed estimates. Our next guest says, given the high bar expectations, the stock could see some softness today. So let's get more now from Denis Taillefer, portfolio manager at Caldwell Investment Management. It's good to have you join us. Good morning.
Thanks for having me.
What are your initial thoughts on the numbers that we're seeing from Dollarama today?
So again, high expectations. This is a company that continuously delivers pretty strong results. And going into this quarter, I think the results have been, well, the expectations have been brought down a bit, knowing that there would be a bit of noise given the difference in weeks and how Halloween kind of fell in one quarter to another versus year over year. So the expectations were a little lower, but the company even missed on that somewhat. So the same store sales, which is really the main metric that most analysts and portfolio managers will look at when you look at these types of companies, was a little softer than expected. Having said that, the company did point to some softness on traffic due to weather, but the basket size was slightly better than expected. So overall, they came in at about 1.5%, I believe. The expectation was about 2.6%. And again, these numbers were slightly lower than what we've seen in previous years. So it was, I'd say, a weak quarter for Dollarama, but not a terrible quarter by any stretch.
And as you say, like traffic was down by 1.6% year over year. That's according to Dollarama. But the company is also forecasting annual sales to be below estimates, signaling softer demand. Is there like a bigger story here in terms of consumer trends and spending and what we're going to see as we head further into 2026 or not really?
A little hard to decipher, but we tend to like a company like Dollarama in just about any kind of an economic environment. Dollarama's got a great business model, so it's a really good growth company. It's very well run and just a fantastic model. And having said that, in harsher times, people will tend to kind of trade down, and so that should help drive more traffic into their stores. So it's a really good core type investment because it really can weather just about any type of economic environment. But having said that, it's all about expectations. And again, this company's been growing at some very good, healthy rates over the last few years, and we're just seeing a bit of a softer patch here, on a go-forward basis. And I think a lot of that will have to do a little more with their growth profile now starting to shift a little more to newer markets, and there's probably a little more investments required into these markets, and that will probably have some pressure as well on their margins over the next few quarters. So the operating leverage we're used to seeing in the business model might be under a little bit of pressure here over the next few quarters.
Okay. So let's take a larger look at the markets now, just in general, because in your notes here, you say you started the year with a constructive outlook, but now you're a little more cautious near term, given everything that's been happening. What's your take on what we've been seeing, especially over the last week or so, in terms of the markets moving up and down? There's been quite a bit of volatility.
Just the last 24 hours, there's been a lot of volatility. So, that's going to be, I think, the kind of the environment over the next few weeks, just a lot of volatility. It doesn't seem like there's any kind of resolution in the near term. So I think the U.S. just miscalculated their ability to basically go in and get this done within a couple of weeks, get this done very quickly. And so the longer this drags out, obviously, the bigger the impact it will have structurally on energy costs, and that will have some negative impacts, obviously, on inflation. It'll have inflationary pressures going up, but as well, it will create a headwind from a growth standpoint. It is basically a tightening of financial conditions for consumers. And again, that lower end consumer is probably the one that will really feel the brunt of it. And so we do expect the longer this goes, the higher the risk for the markets. And then just the tougher it becomes for central banks to really try and manage this, because this is really a supply shock, driven inflation, and central banks have very little ability to kind of have any kind of impact on supply shock inflation. So it puts them in a tough position. They'll be trying to fight inflation, and they'll probably have headwinds to growth on the other end of that. And so it just creates more volatility. And given how the markets were trading at pretty high multiples, we've had a really good run for a while. This does kind of set up the market in the near term for somewhat of a correction.
Somewhat of a correction, and we might be seeing that already, like even in the price of gold, for example. Like, I'm wondering if there's any interesting stories that have been jumping out to you, because obviously the price of oil is the obvious implication here because of what's happening in the Middle East. But what we've been seeing with gold, what we've been seeing with other metals as well, natural gas, like it's been really interesting to watch, particularly the price of gold, I think, just going up and down, even as you say, over the last 24 hours.
It has been. I think that whole commodity segment is going to be very volatile. That's where you see the most volatility, and it'll be very volatile over the next few weeks until we get some form of resolution. We still think from a long-term standpoint, we do think gold is still a valid investment. We still like the fundamentals of copper longer term. And if anything, we do think that the fundamentals for the energy sector are improving through all this, because we do think there will be some structural damage to the supply side of the equation when it comes to oil and natural gas. And so that will basically lead to a higher base level pricing on a go-forward basis. So overall, longer term, we still think these are good areas to invest in. But the next few weeks are going to be very volatile on either side of that trade.
Mm-hmm. Okay, speaking of good areas to invest in, you have some stock picks, and we want to get to those now. So your first one is Hammond Power Solutions. What is it you like about this company?
Yeah, so Hammond Power Solutions, they do dry transformers. So whenever you need to you invest in any kind of building and stuff, you need to basically connect it to the grid, and you need transformers to basically step up and step down that power. So they basically manage the power. We're seeing significant demand from data centers, as well as from the EV network expansions and so forth. And so the secular demand tailwinds are very strong. The interesting part is this company, the stock back in 2024, kind of hit $154 and kind of had problems kind of breaking through that over the next 12 to 18 months. And that was mainly because everybody knew the story was good, that demand was there, but their capacity to kind of be able to supply that demand was not there. They've made significant investments, and we're really starting to see that kick in. So if you look at their most recent quarter, their top line growth, revenue growth was something like 23% year over year. But more importantly, their backlog growth was like 170% year over year. So, or 120% year over year. So it's basically, we're really starting to see that demand flow through. And that's really based on they've been able to expand their capacity with a new plant in Mexico. And they're making new investments this year to expand their capacity by another 100 million. So now they're really in a really good position to be able to fulfill the demand coming down the pipeline. And they're seeing a very strong pipeline of demand, especially on the AI data center build out.
Your other pick, Stella-Jones, has had quite the run recently, up the most in 7 weeks, beating gains on the TSX. What's going on with Stella-Jones?
Yeah, we like Stella-Jones. It's almost like a utility type investment. Now it's a materials company. It's basically a lumber company. They do mainly the railway ties and utility poles for utility companies. So those two markets are really driven by just maintenance and replacement cycle. A good part of that, about 90% of their sales are basically maintenance and replacements. So it's not like that part of the business has a lot of exposure to the economic cycle. It's fairly steady. They've also got long-term contracts, and they've got pricing mechanisms in there to increase pricing. But we also like the pole business quite a bit, because again, there's a lot of investments in the grid modernization and the grid hardening, and that really plays into that business of theirs. And whenever you replace a telephone pole, grid hardening, usually means you'll need to basically have slightly bigger poles and longer poles, and that just replacing that one pole usually represents about 15% increase in fiber. So you've got growth just from that perspective, and they've just made a couple of really important acquisitions that basically opens up a whole new market on the transmission side. So you're looking at the lattices for transmissions and so forth. So they're a small player in that market. It's very fragmented. There's plenty of opportunities to consolidate it, which is really part of their DNA. It's what they've done historically to become the two dominant players in the two markets they're in now. And there's a lot of organic investments opportunities in these new areas as well. So we think they're well positioned for growth, and the bulk of the business, or the core business, is a very steady business that we like in a volatile economic environment.
Okay, we'll leave it there. Denis Taillefer, Portfolio Manager at Caldwell Investment Management. Thanks so much for joining us. Appreciate it.